Hello and welcome to Jim Dalton's presentation this morning for December 21st, 9 a.m. 2015. This is the fifth webinar in a series of 5, Run for the Roses, Navigating Year-End Trading. Jim will review Friday particularly, but last week he will also bring us into this morning what he's seeing. He will narrate from 9:30 a.m. on, and he'll talk about the week ahead and as we round out this calendar year. And welcome in 2016. He'll have some thoughts on that as well. This webinar will go till about 10 a.m. Eastern, when we can fit in questions, and Jim feels like he's done what he can. And we welcome your questions throughout the presentation. Jim will take them as we go. Also, this webinar is being recorded, as the other 4 that go with this series have been. It will be posted at J. Dalton Trading and our YouTube and Vimeo channels about midday. Give me about an hour after we finish to get that thing loaded. And before we begin, Jim and I would like to thank everyone here for taking time out. Obviously a busy time of year, and we all have busy lives, so it's pretty special to have you all here to share Jim's work, and we appreciate it. We'd also like to extend a very happy holiday season to everyone. Be safe, be happy, and God be with us all, and a very happy and prosperous and healthy new year to everyone out there. And with that, I would like to turn it over to Jim. Good morning, Jim.
Good morning, Julia. Thank you very much. We have a lot of things to cover this morning, and some of them are very subtle. Trading is not easy. It is very complex, and we've got 2 important things to cover this morning, and then we'll take a lot of questions. What you're looking at right now is a daily bar chart of the ES. And I put this on Snagit so I can draw on it. The first thing you'll see is, and I'm going to put an arrow here, you'll see a break. See where the market breaks very quickly. And notice, what I want you to notice is the thinness when this market broke. Also reflect upon the fact that the market has in a trading range, and here we have been in a trading range for almost the entire year. I think the S&P and the Dow are down a little bit for the year, and it's been a sideways market. When the market breaks like this and it's very thin in a trading range, the chances are very good that we are going to trade back through that thin area. Normally, this is what a normal market would look like. See how it fills in? And you see, in this way it was thin, it went back up, it filled in. More than likely, over time, once I see this over time, this fills in is going to look much more like a normal distribution. This is not something that we are talking about for the first time. People that are ongoing clients, and normally we just do the reports during intensities, but I do have a few institutional clients that we put out reports for throughout the year. So this is not an unusual concept. We've talked about it for some period of time, for years. We highlighted this period as being very thin and said at that point in time, it's pretty good odds that we're going to trade back through that thinness.
Jim, excuse me, if I could interrupt you. Everyone, if you have not seen, there are 2 reports to supplement this presentation. If you could go to jdaltontrading.com, go to resources, you'll see webinars drop down, and then you'll see another drop down for upcoming webinars. And there at the top of the page are 2 links to download the S&P recap and preparation report, and also the S&P morning report that was written about 8:45 a.m. Okay, thank you. Excuse me, Jim.
Okay. So what we're talking about here is also on the report that Julia talked about. So first it was thin, you see the break. Now, at that point, it's a pretty good chance we trade back through it. And you can see that is exactly what happened. Again, it's still thin. Notice we gapped through the thin part here the first time. The market then traded again back down through all of this area. So this concept is something we've talked about for a long time, and it's something that we've seen in action again. Now, the report, the recap and preparation report that you will be able to pull up, if you've already done it, you'll see it, but I want to talk about something. On Friday, I got very focused on the very tiny short-term ticks and things that were going on in the market. And we're going to come back and we're going to replay that in a little while. What happened, had I done what I'm supposed to do, which is have my long-term charts up in front of me at all times, and I didn't, you'll see in the report, I was in the process of moving, so I'm telling the packers what to pack, what goes to the storage, what goes to the new location. And of course, I think with my mastery, I can just, wing the market and trade. Well, it was absolutely wrong, and you'll see it as we go. But what happened, I got focused on something very tiny, a little tiny day trade in here, and in the meantime, the thinness takes the market all the way back down towards the previous low. I didn't get this trade, and I didn't get that trade simply because I didn't do what I suggest you do all the time, and that's always have the longer term charts, and this isn't even that much longer, up in front of you, and we went right back through that thin area. Now, before we leave this, you'll see in the report, you'll see in the report that I said one more time, I'm not going to be terribly surprised, I don't know how I would it, if we trade back up through here again. Notice this area in the center where I drew the red line. We have traded back and forth through that, but we've moved through it with speed every time. More than likely, we're going to try back up and fill in the middle of this. So when we're all done, looks more like a normal distribution. Julia, before I leave this section, are there any questions just on this?
Oh, you would have to ask me that. Well, people are asking, what is thin? Is it the profile? I had answered, yes, it's the profile, but it's also on the daily bars. So
no,
you want to just address that?
No, I used the daily bars. And you say, what is thin? There is no exact definition. People love exact definitions. They're not there. Notice up here, this is not thin. Notice how it's moved sideways. Notice how this moved down very quickly and then back up. This was thin. This is even thinner. No, the rapidity at which this moved down, which moved up, which moved down. So trading has a lot to do with visualization, visualizing that, this market coming into balance. Thin, 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 and a good chance we go back up. It just doesn't look like the other markets in the trading range. You know how there's more bunching together, and the caveat, this is I'm referring to as a trading market. Sometimes you'll get a thin move like this as a start of a new trend if you're at new highs or new lows. So sometimes that's a start of a new trend. This was in a trading range, and that's what you get. Now we're going to see. When we were down here, I said, good chance we go back up. Way up here, I said, good chance we go back down. Well, I'm saying it again. We don't know if it's going to happen, so it's not something that didn't. Okay, but that's thin. Thin is just something you start to learn by observation. Okay, another question before I move on.
Let's leave it there, Jim. We have some
Okay.
others, but not related to that.
Okay.
I got to go through them too. If I see something, I'll ask it, everyone.
Okay.
Thanks.
Okay.
If okay, Jim, one question about thinness. Isn't it synonymous with low volume? Volume has been fairly average, or am I misunderstanding this concept?
No, it does not have anything to do with low volume. Friday was the highest, I think Friday was the highest Friday was the second highest volume of the year, and the market went down. So no, it's not associated with volume. There's some strange things that go on. They may be around quadruple witching. They may be options expiration. It may be some new issue that comes on or something. There's a lot of things that can happen in the market. Okay, now the next thing I want to do is I want to talk about the market coming into, I want to talk about Friday's market associated with what I just talked about in that thinness. Julia, are we set up so that we can replay Friday this morning?
Yeah, I have it in H period about 1:09 p.m. Okay, so I'll show my screen and you can just walk through it.
Okay.
Let me just get it slowed down a little bit. Can you see my screen?
Yes. Yes.
Okay, I can drop those out. Okay, so overnight is in the blue. We're currently at Friday. Just to get you all anchored, you can see the time date axis. This is Friday's session. Over here you'll see 1:09 p.m. Eastern. So Jim, I'll slow it down a little bit. I'll get it going here, okay?
Okay, before you go any further. Okay, now to put in perspective, remember I started off and I showed you the thin part of the market. Your screen's moving, Julia.
Yes.
Can you
I thought I was going to go higher because it was a gap lower, but that's okay.
No, I don't want to see that. No, I just want to see what's right there. Okay, so keep in mind, we already talked about the thinness of the market, and we were in the middle of that thinness about the time we do this. Now, I also said that I wasn't paying attention to the bigger picture because I knew that I could master all this, and I've missed the big trade of the day. What I then said, I was focused on a very tiny piece of the market, and what I want to do is go to that tiny piece of the market, because while it led me astray, it also reminded me something important to talk about and how to use reference points. So right now, the screen that Julia is showing you is through G period in the morning. If you will look, and Julia, show the white line, which is half back. Half back is a classic day time frame reference. Keep in mind that the longer term has no idea where half back is, nor do they care. So when I see a market that goes to half back and see some activity around that, either stalling or hesitating there, that gives me a pretty good idea that I am dealing with day and short-term traders, that I'm not dealing with the longer term. They could care less about that. Knowing who I'm dealing with in the market has a lot to do with the ability to trade successfully, because I know who my competition is. Okay, so now we're half back. I've already told you half back is a reference, and that half back will change as the day goes on. But at G period low and the A period high, this is half back. So Judah, can we go and let it run just a little bit? You can speed it up just a little if you could. A little bit more.
And so everyone knows, you see the timestamp here where my mouse is. It's 1:28 Eastern. Okay, Jim.
Okay, so the market's open, trying to go lower. It's 2 ticks short of gapping lower. The market's pressing lower, lower, lower. Look at the anomalies. Julia, can you point out the anomalies? Anomaly, anomaly, look up above. And when you see those anomalies,
right
there's
here.
one. Yep, when you see those anomalies, that's usually an indication that the market is very emotionally oriented. People just frantically trying to get short. So when I'm looking at this market, I say, I think they've got them caught short down here, or at least a good chance. I don't want to be long. I don't want to be short in this market. Okay, now, at this point in time.
Here comes Jay.
Okay,
let me just slow it down.
Okay, stop it for just a second. All right,
It stopped.
Okay, I had taken a long position in calls down there. And so just so you know what my position is going into this opportunity. All right, what I see, because I saw the market is getting short. I saw it as a result of the anomalies. I saw it also because we had looked outside of the overnight low and come back in on numerous occasions, which was an indication that this market really, even though price was lower, the confidence wasn't that high because we were in and out of below unchanged. All right, let's keep playing. Remember in here, it's feeling the market's very short. Also remember, this is a continuous two-way auction process. Very important. All right. Keep going. Look at that half back. J period is heading towards half back. Half back is an important reference. Okay, stop right there. Okay, now notice that J period went to a single tick below half back. Very important. J period went to a single tick below half back. The short-term day time frame traders are so anxious they can't believe they want to sell exactly at half back. And that's exactly, so you saw the tick, you saw it go up to half back, exactly. And what I want you to feel, I want you to feel this day time frame traders focused on half back, and they can't wait to sell it, and the exactness and the perfectness that they're looking to sell it, a single tick below half back. Okay, so feel that. Okay, turn it back on, Julia. See him selling, see him selling. Okay, stop one more time. Stop one more time. Okay, now, and this, the phrase I'm going to use now was a phrase that was really originally coined by Julia. And that's when you see this, you say, okay, I had a market that was probably already short. And now when they go and they start selling it from exactly half back or one tick below it, guess what? They're getting the market even shorter. They're getting the market even shorter. And it's a dangerous situation. The other thing, what I want you to
Sorry, that's my monitor. Go ahead.
Okay. When I see a reference, when I see a market rally to exactly a reference or one tick above it or below it, I classify that as weak. And why do I classify it as weak? Because it is done by the weakest of traders. Long term, I've told people a lot of times, I used to run an institutional desk. You would never wait till you got exactly the half back or a tick above it or below it to be a seller. You have too much size. You would absolutely lose your business, lose your accounts if you tried to be that exacting. Who tries to be that exacting? The weakest hands traders looking for the perfect trade. Okay, so now when they sell it from exactly half back, more than likely they're getting short. Now, let me clarify here. If you are a very agile, short-term trader, and you understand half back, you may want to be that seller. But that means you're agile, that means you're only looking for the quick hit, and it means you are ready to get out of there immediately if it doesn't work. If you are a trader that's puts the trade on and now you're going to wonder and hope for the best and not let it go unless you get what you want, and you're a stubborn trader, that is not the trade for you. Sometimes it works, but that is not the trade for you. It has to do with your personality. Okay, let's replay. Let's keep playing.
Could I clarify one thing, Jim, you said too, because I hear this often. When Jim says they're the weakest hand traders, Obviously, what he's meaning is that they're not traders that are looking to put on size to start unwinding from long-term positions, and that they're directionally looking for a longer-term play, which, you know, bigger money can do that. What he means is there can be large pools of capital and hedge fund traders with billions in the market who are just looking for short-term momentum day trades, short-term trades. So the point is that they sell it from half back, but they're not convicted or really committed to that position. They're just taking advantage of day time frame momentum. So it could come back on them. And
yeah, it's not quite right. There are some pools of short-term capital that are very large, and they are looking for the quick hit. But they're not the people that are trading a tick below half back. Their size is also big. They trade in 1,000 lots and plus. Their size is still too big. The people that sell exactly at half back are generally the day time frame traders, the very short-term day time frame traders. They're shorter than the time frame Julia was talking about. Now, these two time frames do intermix, so when I say the weakest, it's the think of the folks that are out there looking for just a few ticks. They will change their minds very, very quickly. And the shorter term traders, they have maybe, you know, a multi-million or $1 billion accounts, they will change their mind, but normally not after 5 or 6 ticks. They're looking for 4 or 5 handles in there. So it's a little bit different. When they go to 1 tick below half back, it is the shortest of time frame, which usually day time frame traders. Okay.
Okay, thank you. And my point is that this is the theory behind, or the thinking behind why is it weak? Because it could easily come back on them because it's just day trading money. So I just wanted to add a little background.
But you're absolutely right. It's not the serious money that's going to hold a position even overnight. Okay, let's go ahead. So now they've sold it off immediately. I want you to just feel that, how fast they sold that off. See them pushing that market lower? Those are the people that sold it automatically. And it's, like I said, if you're very flexible, it's okay. But boy, you got to be careful because it can come, they got to be even shorter and come back at you very, very quickly. Okay, now notice it went, okay, now stop right here, please. Now it has taken out half back. So look how fast that market went down, look how fast that market came back. Now is the real moment of truth. If you fail above half back, normally what happens, once you get above half back, then the short-term traders come in and buy it. If it fails above half back, now think of the slight difference between a tick short of it, exactly at it, or a tick above it. The first time we saw it failed a tick below it. That came back and took that out. If it fails above half back, that is probably a more significant reference for the day time frame. If it fails above half back, it's still not the longer term money, but it now may shift to the time frame Julia was talking about, these short-term hedge funds and people that have a lot of money that can trade very aggressively. All right, let's continue to play. So you see we're back and forth through half back.
It's a tug of war.
It took it out by another tick. And just feel the emotion. Okay, now J period opens in there. Remember, okay, let's stop right here. Okay, now you'll see in the report that the clue up here was when we failed above half back the second time. When we got above it and didn't start to extend to the upside. To me, that was a clue that this was over on the upside for today. Now also remember, at this point, Where is value? We trade value, not price. At this point, value is clearly lower for the day. That was an exceptionally important point right here. What I want you to take home, and then we're going to get out and talk about today, what I want you to take home is that we went a tick short of half back. They sold it off very aggressively. Short-term traders sold it off very aggressively, got the market even shorter. The market came back very quickly, took out half back, and then you saw take out, come back and forth, fail again at half back, and then that more than likely is the end of it. And you'll see that's what I took to be the end of the rally for that day. And where I went wrong is I'm so focused on this short little piece of information and this tiny tick back and forth that I looked and missed the whole thinness of that market and the chances we're going back down through it. So let's quickly play out the rest of the day. Julia, you there?
Yes,
Okay.
Jim, just to clarify, you said short-term traders sold it shy of half back. You meant day traders sold it shy of half back, and now the exhaustion. Go ahead. Day
traders more than likely sold it one tick short of half back. Then it came roaring back through it. The shorts got caught again. The shorts got caught. They came back up through it. The market was already short. They got it even shorter. Now, when we go back and fail, more than likely we have more serious short-term traders selling when it fails.
Okay.
Okay, let's play it out very quickly.
And that now serves as the rally high of the downside move.
Absolutely.
For Friday.
Okay.
A good reference for this.
Put it on full speed so we can just so you see what happens from here.
Yeah, because we're looking at 2 minutes to the bell.
Yeah.
But that's okay. We'll took some time.
Okay, so what I wanted you to see that the market goes down the rest of the day. It's some volatility, but we can stop right here. I wanted to see that point. You can do this same analysis with any reference. Okay, and we talk about this consistently through the intensives. I'm going to leave this for now. Julia, can you take me back and let me have control again?
Yes, and this is Window Trader Blue market profile software.
Yeah, let's go.
That has a replay feature. Go ahead, it's back to you.
Okay, here's what I wanted. The report, the morning report today, starts off with Thursday the 17th. This is a prominent point of control on Thursday the 17th. You see the market extended lower. This was the first alert that the market was getting dangerously short. The point of control is also the fairest price at which business is being conducted. Traders are getting short in the hole. Friday, so it's a very dangerous thing. Friday, the market broke again. Notice all the anomalies. 1, 2, there's 3, 4, or 5 anomalies. The market breaks and closes down here. The point I was trying to make, and you'll see it in the report, that the market was dangerously short.
You want to make that a little larger, Jim? And there's people commenting on the 45 line too, but we'll listen to Jim narrate the open here.
Dangerously short from Thursday, from Friday. This was the emotion in the market. People are going on oil and everything other than what they probably ought to be looking at. Now, and you also had quadruple witching. Think about this. I want you to start to think in terms of your competitors. How smug those people that went home short probably felt on Friday afternoon. And I'm sitting there saying, I think the market is dangerously short down here. Now, let's talk about a trade. Did I think it was dangerously short? Yes, I did. Did I go home long? No, wasn't interested. But last night, as soon as we opened last night, I was already saying the market is probably dangerously short. What I wanted to see, I ideally wanted to see a market that didn't open down on Sunday. If the market doesn't open down on Sunday, what do you think those traders are feeling that were so smug from Thursday and Friday's break? And at that point in time, now I'm going to change subject for a second. At this point in time, and you're going to see this as we go through these intensives coming up, we've added a section on options, and they're not traditional options. They're not for people that use Greeks and everything else and looking at options. They're kind of the way I will think about options. When I look down, when this market opens last night, and it doesn't take out Sunday's low, or it doesn't take out Friday's low, I'm trying to get inside of the head of the people I'm competing against. I already believe that they're dangerously short from Thursday and from Friday. Now, at this point in time, okay, I can go in, and I did go in and buy the 2030 call options, and they were, I think they were down
this
around.
Is S&P.
E-mini,
S&P futures.
S&P
E-money. This week, weekly options.
Weekly, they expire this week, so they'd be week 4, and they were able to get them just slightly under $4. And it's just a way. It's a way to play. It's a way to play this market that gets dangerously short. Now, I took them off right around here at 7 this morning. They'd gone higher, but it was just a short-term trade in it. But it's another thing you can do. I'd probably be too afraid to use futures. I'd never sleep at night. But I'm saying, the market's short, and it didn't open down. We didn't get any carry to the downside. More than likely, you're going to have a lot of pressure on the shorts. So now you can see what's happened. We're back up through half back. We're through the anomalies from Friday, not all of them. We've still got one up here. Notice anomalies, how often we will see a market retrace. The anomalies are an indication of emotional selling. When you get institutional or buying, yeah, depending, in this case, I'm selling because the market was going lower. When institutions are in the market, you generally get a smoother profile. It's the shorter term traders, day and shorter term, that are just so emotional, just afraid they're going to miss a market. Now, I'm going to switch to one other topic here. Remember how much time we spent focusing on the half back area from Friday. And then the market finally broke from half back and extended on the downside before the day was over. It is still the fact that it came from half back, and how many times it went back and back and forth through half back. It was a good assumption that it was shorter term trader, not day trader, but shorter term trader, which have bigger pools of capital, and they can drive the market considerably. But it's probably not longer term money. Longer term, or what we call sticky money. Longer term or sticky money isn't going to wait for half back. They're not going to wait for that time of the day. So again, the subtleties of understanding markets is difficult. It is difficult, but it is understandable if somebody will guide you through what really goes on and allow you to open your mind to think and get inside of the head of the people you are competing against. You have to give up the idea that price is important. Okay? Yes, I'm sorry.
Yes, we have several traders now. One signature trade is a look outside of range and fail. That could be overnight range, pit session range. We're looking above the overnight high, and obviously there's a little tug of war here. Do you have any comments for them for that particular trade? Is your bias now long that we went through the overnight high?
No.
People are asking it a little differently.
No.
So
Where we are, we opened within the about the center, a little bit above the center of Friday's range, but we're well within Friday's range. Usually when this happens, we have a rotational balancing day. So, and I said in the morning report, usually when we open around here, I just let the market churn for a while. I got in last night.
Around here, meaning in the center of range.
In the center of the range. And so you're going to get a lot of panic this morning, early off the open. You're going to get people that were caught short. You're going to get people that, oh my God, I got a chance to sell it higher. You're going to, more than likely, when you open within the previous day's range, you're going to get a lot of chop. And When we
Jim,
open within the range,
okay.
I like to avoid that chop. Yes.
I beg your pardon. If you slide it up a little bit, overnight inventory is long as well, and we know 65 approximately % of the time we see an adjustment of overnight trade. So do you believe that, I mean, obviously now we're sliding away from the overnight high, but that an inventory adjustment is in order, or that may be muted, or at least, it's extenuating circumstance that we
That's
were
correct.
so short
Yeah, we
on
would always
Friday
have,
and Thursday.
yes, extenuating circumstance. See, if you just blindly take the thing 65% of the time, you get a counter auction, a reverse auction to overnight inventory, and you might find that doesn't work unless you say, okay, are there extenuating circumstances? If there were no extenuating circumstances, in other words, we didn't think the market was overly short on Friday, then the odds of a counter auction would be much higher. Because the market was so short, both from Thursday and Friday, that lessens the chance of the counter auction to overnight inventory. Now,
And Jim,
so this it's lessened this morning. But let me, I know you got a question. Let me say one thing. The question about the overnight high and low are always day time frame references. So if somebody was long, you probably want to sell at the overnight inventory, because if there's going to be a problem,
overnight high.
Overnight high, that's probably where it's going to be. If you are a short-term agile trader, you want to short as we come back into the overnight range. That is perfectly legitimate trade as long as you understand the need for being agile. And if it doesn't work, you've got to get out very quickly. But it's a very legitimate trade. When you open within Friday's range, remember I said I expect chop, and so you're going to get some people that are covering shorts. You're going to get some people say, oh my golly, I got another chance to sell at a higher price. Chop is there. The overnight inventory is a legitimate short.
Okay, Jim, and if you could mark the overnight high, and also we just went through Friday's session. We talk about the rally high or pullback lows when we're on a trending day, and the J period high, if you mark that, the market just tapped it. I think that's an exact.
Perfect. Yes.
Yeah, so, again, has anything changed? If you could talk about that concept, Jim, that if the high or the pullback low or a rally high like Friday on the J period high holds, nothing's really changed from the auction that was downward on Friday. Do you just want to address that there?
No, it's a good observation, and it's not. It's doesn't lose the fact that the overnight high was just short of that level too. That's where a lot of activity took place from this level. So it is very common. So what Julia is saying, and a great observation, is really, even though there was a lot of downward price on Friday, a lot of emotion, nothing has really changed relative to Friday afternoon. We had some really emotional sell-off on Friday. We've had some short covering today, but nothing's really changed. So that's a great observation, because the rally high is always a major reference. I missed it. I was sitting here talking, doing other things. Julia picked it up. It's always a reference high. The overnight
we had
high,
traders that pointed out, so I saw it, but we have several people that were putting it on the screen, so typing it in.
Take full credit, Julia. Take full credit.
Right.
Okay, but again, those are things, people that pointed this out, those are things we consistently teach, how to use a reference. It's not just the reference, it's how to use the reference. A lot of people don't know how to think about it. Julia just talked about how do you think about it. When you become a good trader, you're no longer just looking at prices and exactly where do I get in, where do I get out. You're much more learning how to think and how to reflect on the market and who are you competing with. So, and again, then that doesn't mean that we don't use mechanical references. You notice when we talked about Friday, we talked about a mechanical reference, but we talked about how to use that reference just rather than saying mechanically it's a reference. We used the overnight high.
sorry.
Go ahead. I'm sorry. I'll stop.
No, I beg your pardon.
We used the overnight high as a mechanical reference. We used half back as a mechanical reference. So it's not that we don't use them. We use different references than most people. Go ahead, Julia.
Yes, thank you. Excuse me. People are asking, even though the pullback, the rally high held and nothing's changed from Friday afternoon's down move, is it not a weak high today because it went exactly to
Perfect.
that reference? Again,
absolutely.
People are asking this, so great.
Absolutely.
Okay.
Absolutely. It's just a great observation. And obviously, these are people that have been with us for a period of time. And I'm guessing that they didn't learn this on the first intensive. One of the things that we find with people that have turned into successful traders, they haven't gone to one intensive, they've gone to more than one, and they continually say things like, you can't hear this enough, because there's always little nuances different. It's always dynamic, it's nothing static, but that's right, perfect comment. The fact that it went exactly to half back is a weak reference because it went to a mechanical trade. So again, you're saying, what did you have up there? You didn't have long-term sellers up there. You probably had short and daytime frame traders. Again, very important observation. Go ahead, Julia.
Let me just see. Give me a second, everyone. The 45 lines, do you believe they're factoring in today? I mean, first of all, just to mention, this is where we stay out of trouble. We opened in the center of Friday's range. I can imagine that many traders have been chopped up in here. It hasn't been easy to read. So that's one thing, just that we can wait and let the market shake out. And I've been eager and over-eager in years past, and Jim will say, if you just sit it out and you're patient, an excellent trade will present itself. Just hang in there and don't be so over-eager to get in a trade. I just want to share that with people. This is kind of a case in point of opening in the center of range and a lot of chop.
And let me clarify something that can be easily misread. I said usually when it opens within range like this, I just let the market set up. I'm not too anxious to trade. That somebody else could say, well, that means you wouldn't have sold when it came back into the overnight range. It doesn't mean that. It means that I wasn't. As soon as we opened, I'm not eager to make a trade. I'll let the market chop around. I'll see if it gives me some kind of sign. And that sounds mystical, doesn't it? But it did. So even though I might have traded 5 minutes after the opening, I didn't trade at the opening. I waited till it went up to an identifiable reference level. The rally high in J period, combined with the overnight high, a very legitimate place to put out a short. Number one, I also said if you were long, that was a logical place to take off your long, because if there's going to be a problem, more than likely it's going to be at the overnight high or at the afternoon rally high from Friday. Why would it be a problem at the rally high from Friday? Because there's a lot of traders that remember how much reward they got from selling at that level on Friday. They have memories. And I've seen a trader, I knew one trader, he used to go into the market with up to 27 numbers on his trading sheet when it used to be on the floor. So people they mark those levels down, they remember those levels. You can say, I talk about the levels all the time in there. So not trading right off the opening doesn't tell you that you can't do a trade when it gives you a clear, and this is what we call an asymmetric opportunity. Why was it asymmetric? And this is what we're looking for. Because the risk was limited. If you're shorting up here when you come back in the overnight range and the rally high, you got a very tight stop. And the potential reward could be much greater. You got an identifiable stop, and we call that a structural stop because it's based on structure. One of the things that we try and talk about in the intensives is not to put money stops. Money stops, I'll risk $500 or $200 to do that. That is just an absolute terrible way to trade. You need to have your stop based on something that is structural in nature, something that would indicate change. Trading is about change. So when we got up here at Julia brought the word out immediately, we got to Friday afternoon's J period high, nothing had changed. We can't, a great place for a short, you've got an identifiable place for a stop, and you've got an asymmetric opportunity. Now, the next question is going to come up. The overnight profile, it's a double distribution profile. Do I use the overnight structure for trading? The answer is generally no. I do have an exception, and an exception is when there's a double distribution, because something clearly changed in this area. So I came out of here and I changed. So the bottom of this distribution is kind of it's not a tremendous reference, but I do use it because from the change, as long as I stay within this range, there's no real change relative to the late overnight. It's just something that I will do from time to time. Other questions, Julia? We've covered a lot this morning.
Yes, thank you, Jim. If you had shorted above the overnight high, and I know there are traders in here who did that, would you still be short?
No, I'd be out at the, again, let's set the base. Short-term trader. Short at the top, come back into this low of this upper distribution, I'm out. As a short-term trader, and maybe I had a longer-term motive, I would be still there. But as a short-term trader,
or a day trader, really.
As a day trader, I will take that trade. If there's going to be a problem, it's going to be here, because this is where something changed. Just like I said, there's going to be a problem on the long side, it's probably going to be here. So if I got short here, I'm out here. Good question. Thank you.
If the market is dangerously short, why is it still going down?
Well, it's not down relative to Friday. It's up relative to Friday. And this day's not over. I mean, there are going to be people, remember, there's going to be people that are automatically shorting because it sold off from here Friday. This day is not over. The shorts from Thursday haven't covered yet. Some of the shorts from Friday have covered, but we don't know what's going to happen in here. But dangerously short, I'd say we're up. What are we up? 20 handles. So there's been a lot of short covering here, but we don't know it's over, and we don't know what the rest of the day brings. Other questions?
Okay. Yes, hold on, Jim. I'm just going through. Excuse me, everyone. Someone had gotten long at 2007, so they're using it as, that base of the overnight distribution to take a long.
There's nothing wrong with that trade. Nothing wrong with that trade at all, because you're sitting down. You've got a reference. You've got a reference. You want to stay above this distribution. That's a very legitimate long. You think the market's short. You got a reference. You got a place for the stop down below here. Very legitimate. And these are great trades for short-term traders. But remember, when you're getting long at that, it's not a just, pick it out of nowhere type of thing.
Don't you mean for day traders? You're saying short-term traders.
No,
don't you
day
mean
traders.
Great trades for day traders.
Day traders. It's very legitimate. But then you've got to monitor for continuation. I'm always looking in the right-hand corner. It's 7:50 down here. So we're going to change time periods in 10 minutes. Right now, we've come back to the opening. As a day trader, the opening is also a very important reference for day time frame traders. Now, this market has rallied right back up to the opening. Notice how it hesitated around the opening. The opening is also half back. Okay, so that's another day time frame reference. Notice the back and forth around the opening.
The volume on window trader, excuse me, Jim, very quickly, there's two questions. This is futures volume. It goes
Correct.
with the contract being traded, okay? Jim does look at nice volume. You can see that online. I mean, he looks at it visually every 30 minutes. We have someone who coded it for us every 30 minutes to capture it at the training site and at J. Dalton Trading member site. Friday's J period rally high level looks very unfinished in terms of today's volume. Is this a long queue?
I don't know. I really don't. I'll come back to that in just a second. Notice I said on a day time frame basis the importance of the opening. The opening and half back. It's one and the same today. And it got back. It couldn't carry above this, and it broke. So now they're exploring the downside. Remember the continuous two-way auction process. Now, one of the things in here you should be asking yourself: is there any confidence this morning? No, it's a very low confidence day. We expected rotation in here, and we're getting rotation in here. This is a weak reference up here, but it's from a day time frame trader's perspective. Somebody that bought it long down here, when you can't clear and get above the opening, the chances are we're going to go back down and look at the lows. Day trading is a very difficult way to earn a living, and you have to be very flexible in it, and you have to be able to move pretty quickly sometimes. When I saw this market get to the opening and couldn't get above it, couldn't carry it, I think I saw it go a tick or two above, no lift, be careful, now it's going down. So that's what I'm saying. If you're going to do day trades, you've got to monitor closely for continuation. How do you monitor for continuation? You're going to look at half back. You're going to look at the opening. You're going to look at volume. I'm sorry, I'm talking very quickly. This is, without a question, the most complex day we have talked about during these first 5 intensives. Friday was webinars. I'm sorry. Thank you. Friday was complex, the way it worked around that reference, but just because it's complex doesn't mean it's not right. One time somebody wrote a comment on one of the book sites that the problem with Dalton's books, it's too complicated. Guess what? The amount of money and the potential that's involved, yes, it's going to be complicated because you're competing against the best in the world. And unless you have somebody really walking you through the things to not the where to buy and where to sell, but how to think about the market, you're not going to have a lot of chance. You've got to get inside the head of people you're competing against in here. Okay, right now we're still within Friday's range. It's still balancing. It's still fairly rotational, and there's a lot of chop still going on in the market.
Mm-hmm. And the volume's looking relatively light. People keying in volume, which we would expect. It's a holiday week too, correct, Jim? I mean, we have to remember that.
Yes.
Coming through all this, it's a lot of people are taking the week off or getting ready to.
And the longer term money, the longer term sticky money, if their year's either made or it's not made, they're not going to be terribly interested this late in the year. They're not going to take the chances this late in the year. They're not going to, if they're behind, they're not going to make it back, and if they're behind, they don't want to trade and make it worse. So you're probably left for the rest of the year with a lot of trading money. The shorter term money, trading money, and it can be very fickle money and very difficult to stay alive in because they will change on a dime, and they'll run, the herd will run very quickly one way or the other.
Okay, great. Thank you. If you're looking for the shorts to cover, who is going to drive the market higher for the shorts to cover? Shorts covering, they're buying to cover, so they can drive the market higher, and then you have new money or people who are flat and looking to get in and smelling blood in the water, they can enter and bid the market up. So if you want to make any comment in addition to that,
absolutely. The question of who's going to drive the market higher, that is that's a question that you really have to reflect on that. Think about if people are short, there's only one way to get out of a short. You have to buy it. So you don't have to, if a market gets too short, you don't have to have any new money coming in to get one heck of a rally. The shorts start to cover. You know, one of them, we used to see this down on the floor of the exchange all the time. All of a sudden you get everybody on the floor short, and all of a sudden one of the big guys in the pit realizes this. He puts his hand, if you put your hand straight up with the palms facing you, that means you're buying. So a big guy in the pit would realize that the majority of people, smaller traders in the pit, were short. He put his hand straight up in the air with the palms facing, means he's bidding. And when he bids, the shorts start to cover. But once the shorts start to cover, they feed on each other. One short buying in, he forces another short to cover, and then as it gets underway, then you get the momentum traders that say, wow, we've got upward momentum. Then the momentum traders come in, and they start buying, and they drive the shorts even higher. One of the games that used to go on, and it still goes on today, it's just
they drive the price even higher.
In bigger size. If I'm in a floor, for example, in the old days, let's say I'm a normal 5-lot trader, and all of a sudden there's bids in the market, so shorts are coming, I may become a 10 or 15-lot trader because there's basically no risk as long as there are bids underneath the market. When you see a market that gets caught short, it's not unlikely that you've got short-term traders that have a lot of capital to say they're caught short, and they come in and they start bidding that market up. And that takes prices even higher. Okay. As you can see, we went to half back, and the opening, no follow through, didn't get back there. The pressure remains on the downside.
Jim, thank you. This question, it really speaks to trade location. If you were daytime frame trading, where would stops be placed for the short or the long side? So it's a general question, but
if I was a daytime frame trader, the short would, the exit would have been, the entry would have been right up here with the stop right above it. You know, if you get in.
So the stop would be a few ticks above the J period rally high or the overnight high.
Yeah. Now, somebody else
wouldn't be.
Somebody else that gets in here someplace and asks where's the stop, I have no idea where you want to stop, because risk control is very dependent upon trade location. Trade location is very dependent upon getting your getting your order placed near some structural place where you know very quickly if you're right or wrong. If you're short up here, you know very quickly if you're right or wrong. If you short someplace in here, you don't know very quickly at all. You can
in the middle of the range.
In the middle of the range, and you know, if you say, well, you're no good, you can't tell me where to put my stop in there. Well, it's not a good place to be the trade. Sometimes we have to have the patience and say, I'm not trading because I really don't know. If I don't know where to put the stop, I don't want to trade because I'll be too nervous. I'll end up with a money stop. If I did a long down in here, okay, you got a couple places to put the stop. You can put your stop at half back overnight, mechanical, but the market will respect it. You can put it down here if it closes this gap.
Not gap, but the single print.
The single print. I'm sorry.
The double distribution.
This double distribution. So again, the circumstances will always change, but it all starts with getting decent trade location. Okay.
Okay.
So where are we right now? We said the expectation was that we were going to open within about the center of Friday's range. We opened above the center. We went up to the overnight high. We're trading just about the center of Friday's range right now. We said we expect chop. Guess what? We're getting chop. So far it's an inside narrow range. The market's just allowing itself to come into balance relative to inventory that was very short on Friday's close. No, I see no new buying in here. All I see is short covering so far.
Okay, Jim, thank you. And in Jim's experience, do these holiday trading days offer good opportunities for day traders, or are they markets to stay away from? Generally speaking, I know there'll be exceptions. Do you have any comment about this time here?
I have seen some excellent trades during this time for daytime frame traders, simply because as long as you As long as you say, okay, I understand what's going on. I understand the market is thin in here. So it's mostly daytime frame traders, and you know they're emotional. Sometimes there's great opportunities. You don't want to get married to anything, but because you know who you're competing against, it's unlikely that the longer time frame is going to appear in the scene and spoil your parade. No, I found it, I'm not overly anxious to trade because it's going to be volatile. But if I get a good opportunity, for example, this to me was the best opportunity so far, right up near the J period high, rally high, overnight high, and the exit that I saw it was right down here at the lower end distribution. So I saw it as a very good trade for today. That's the only one. It's the only trade I've seen that I was interested in. But throughout the day, there'll be 2 or 3 of those.
Yes. Do you believe this is too many? Well, it's kind of filling in now, but they were saying too many single prints. I guess when we were on the lows, it probably is when that type question was put in, that A period had several single prints. Maybe you could make that a little bit bigger, Jim, just so people can see. But do you have any comment about the single print? It was a low confidence market.
Sure, it was a lot of single prints for being inside the previous day's range. It also mechanically went down, to the lower end of the lower distribution. What it tells me is, remember, markets are very visual the way they trade. One of the great advantages of the market profile, it allows you to really visualize the market structure. If you're just looking at price, you don't see the depth that the structure brings you a much greater depth of being able to see the market. And you can trade the market, and you see it went right down to a very visual place. It went very visual up here at the overnight high. This is very visual because you could have marked it ahead of time. So yeah, it was a lot of single prints. Look at it one more time. Where is it stopped? One tick at the below the opening. Again, what do you think the confidence in is here? It's very low, a lot of chop, and that's what's to be expected.
Okay. So we have been repairing poor structure back and forth for a few weeks now, actually months really, but how does that resolve itself? Until we see a big money bid under the market or the long-term players start selling when their hedges come off in January?
Who knows? It's, you just don't know. Trying to outthink and predict the market is very, very difficult. Almost everybody that did it last year has been wrong. On here, and what I think, and I might have a view that particularly for the people, the clients that we have, you are much better off to learn to be a reactive trader, and that's react to what is going on in the marketplace rather than a predictive trader. Now, let me give you another thing that's complex. The market, there are a lot of random events that take place in the market. A random event could be all of a sudden you get a big rally in oil or a big drop in oil. The dollar is very strong or the dollar is very weak on a sudden basis. Some news announcement, some Federal Reserve member comes out and says something. For example, Friday afternoon, it wasn't too long before the close, one of the Federal Reserve, I think it was Fisher, came out and said 4 rate hikes next year. That may have pushed this market even lower. However, here's the subtlety. There are a lot of random events that take place in the market. However, one random event may change the odds going forward. So you think, wait a minute, something's random, it should be 50-50. But a random event may, in fact, change the odds for the next market move. Now, that's somewhat complex. But if I take a look, going back to where we started talking about on Thursday, we started looking last Thursday and saying this big break, and so part of the random event may have been, some oil news, it may have been coming into the expiration, but it changed, in my opinion, it changed the odds going forward. It lessened the odds for going lower. It raised the odds for at least a short covering rally. That's a kind of a complex statement. It's a very complex statement, but it is really interesting. And one of the things that I like about that, when you have a guy like Taleb that wrote Fooled by Randomness in the Market, never explored that concept. He just started Fooled by Randomness. And then it hit me the other day. I was reading some stuff on biology and genetics and things like that, and all of a sudden you realize that there is a lot of random things that take place in genetics. However, one random event in the development of the human embryo or whatever, genome or whatever it is, all of a sudden, but it does, that random event may change the path of the next event going forward. So while it was random, it may change the odds going forward. Anyhow, and I think that's what happened when the markets get too short. It may be a random event that took it too short, but that may increase the odds of a short covering rally. Okay, what other questions? We're over our time limit, but what other questions might we take this morning?
Jim, the VIX, you discussed the issue of the VIX in the intensives, and what is your take on the VIX readings throughout the day?
I don't look at it very much. I mean, I'm somewhat aware if it makes really big moves, but
you're seeing it on the ticker. You're watching it and aware
sometimes
of it.
I'm not always. I don't have the ticker up anymore. I go on and off with it. I'm aware of it, but the VIX has been historically wrong at really important places. So I don't spend a lot of time. I get the majority of my information from looking at the profiles and the structure of the profile. It gives me an awful lot of information. Mm-hmm. Okay, can I
okay, great.
I do a commercial? We've talked about a lot of things this morning, and I mean some important things, but certainly not easy, and particularly not easy for people that are accustomed to being price oriented. I think it's important to say we are not profile traders. We use the profile in order to understand the structure of the market, to organize the market's continuous two-way auction processes. Just as you saw that two-way process this morning, we looked up at the rally high from Friday, said it's a great place for a short, but it's still a weak high this morning because it went exactly to that reference. So this certainly isn't a sign that we had heavy-duty selling up here. It was a mechanical thing. We watched the two-way auction process. We watched it go down. We then watched an auction take it back up to half back. We watched an auction take it back down. Now we're watching an auction back through half back, trying to go back up towards the highs. It's that continuous two-way auction process, and we record that using the market profile. That helps us cut through all the noise as the market goes up, down, up, down, up, down. We're trying to sort out and get a better opinion of what is actually going on when you take these thousands of different opinions and sort them out as what is the most prominent thing going on. It takes a lot of time, and that's why Julia came up with the idea for the intensives. We would do 3 and 5 day seminars, and we would put our heart into them and try and give you everything we had. But guess what? Over 3 to 5 days, you may get stuck with a very limited movement in the market, and then your learning isn't really expanded because you're not seeing a lot of different markets in action. The intensives allow us a lot of different markets, a lot of different circumstances to give you a much broader sense of experience. If you remember, if the continuity program, we actually started doing reports on the 14th of December, and they'll go through the end of the last intensive. So you can really put several months together to make this information become yours more and more. Importantly, what we're trying to do is teach you how to think about the market. And once you learn how to think about the market and think about the people you're competing with, your trading is probably going to do nothing but get better. But anyhow, we'd hope you join us. We've had great response to the continuity program, and I want to thank you all for being with us this morning. Unless you've got a final question or two, Julia, I'll say thank you and Merry Christmas or Happy Holidays.
No, thank you. Yes, thank you, Jim. No, it's great. And we used to call them accelerated learning intensives because really we could look at the market for years, and if we're not looking at the correct information or we're just, trying to make our way through and figure out as we go, it can be a long and arduous process, which anyone who's been trading for any amount of time can identify with that statement. So by doing it in a 5-week program or 10 weeks or longer for the continuity option, we're hoping to really collapse the learning curve and enable you to see things in a very short amount of time. Yes, you have to be committed. Yes, it requires some dedication and some open-mindedness to take it in, but it's our hope that we can really accelerate your learning and help you to see many different parts of the auction process and see the markets the way Jim does, and understand inventory and who we're competing with, behavior around references, value, structure, and all these elements, trends, time frames, who's dominating the session, and all of these things that come together to create our market logic and market perspective. So that's our objective in the intensives. And Jim, I want to thank you from everyone.
Let me make one more comment. Remember, when the intensive is on, I will add a couple of chat comments. I had several chat comments throughout the day, one-way chat, so I continue to get input, things to focus on. Between the first and second intensive, I will do at least 2 chat comments a day in order to, give you some of the more pertinent information. And then, of course, then you get full-time chat comments again on the last intensive. So we've tried to tie this together. So from start to finish, if you take the continuity program, we're close to you the entire time and trying to guide the learning. But thank you again.
Yes, thank you, Jim, and thank you, everyone. Merry Christmas, Happy Holidays, Happy Hanukkah, and all Kwanzaa, and all the wonderful spiritual traditions and celebrations that are happening this time of year. We wish you all a very safe and happy time and a wonderful new year, and we will see you back for some more webinars after the start of the year, and we will email you that schedule so you can participate. And thank you, everyone. Thank you, Mr. Dalton. Great job, and have a great day.
Thanks, Julia.
Thank you.
Bye.
You're welcome. Bye-bye.